Hello, and welcome to Financial Perspectives, a CFA Society San Francisco podcast, where we interview and discuss trends with leaders from across the investment and finance industry. This month, our host, Tanya Suba Tang, Programming and Membership Director with CFA Society San Francisco, had the pleasure of welcoming back Pooja Malik, Founding Partner and CIO of Nipun Capital. Listen in as they discuss the shifting risk dynamics between the U.S. and emerging markets.
Pooja, so great to see you again. How are you?
I'm doing well. Thank you for having me, Tanya.
I'm always excited to have you on our podcast. This is the second time you're with us, and I'm very excited about our conversation because a lot has happened in the emerging markets. And so, I'm going to jump right in here. And for a listener, the last time I spoke to Pooja was back in 2024. Can you believe it? I still feel like it's 2024. I don't know where the years went, but I'd love for you to share with our listener what has changed in the markets since then. And I'd love to know what has surprised you.
It's a good question, Tanya. So a lot has changed, even though it's only been 2 years or maybe even 18 months since we last spoke. And let me try to recap. Broadly, I would say 3 main changes. The first is investor sentiment around emerging markets has changed a lot. And to me, that is the most important thing. When we spoke in 2024, emerging markets had been underperforming developed markets. U.S. equities had been on a decade-long bull run, and it was an era of U.S. exceptionalism. You remember that phrase. And what's changed is today, U.S. equities appear to be overpriced, or at least priced for perfection, where most of stocks in the U.S. appear to be what's called glamour stocks. And at some point, when these stocks miss earnings expectations, which are very hyped, that's when we are likely to get a correction in the US. Now, the fact that US equities appear overpriced combined with dollar weakness has strengthened the appetite for EM. The dollar weakness is coming, of course, from the Federal Reserve decision to cut rates, but also from political uncertainty in the US. So the backdrop of the US equity market has led more investors to look at EM. And I think that's been one big change around foreign investor sentiment being more positive for EM than before. Now, another thing that has changed is that policy support from the local governments in EM has become stronger. And the impetus for that was when the US announced tariffs in 2025, many of the local governments felt compelled to provide policy incentives and other measures to support local markets. Some local governments even encouraged domestic institutions and banks to buy stocks to support their local equity markets. We saw this in China, we saw this in Taiwan, and we saw this in many of the smaller EM markets. So as a result, all of this attracted domestic buyers of stocks into the markets as well. And since 2024, especially looking back at 25, we saw domestic institutions becoming net buyers. So in essence, now you had multiple sources of demand for EM equities, foreign investors as well as domestic investors. And then to top off all of this, the icing on the cake has been the sentiment around AI. And I see you smiling there, right? That's been a hot topic across equity markets. There was positive sentiment around AI in 2024 in the US, of course, and for many years in the US. And then last year in 2025, we saw it impact Asia more broadly. And the largest impact was in Korea, where stocks like Samsung were up over 100%. SK Hynix, that is the largest manufacturer of DRAM chips, right? That stock returned over 300% last year. So, you asked me what has been surprising. The fact that AI became a theme in Asia and EM is not surprising. I think what has been surprising is how strongly retail investors latched onto that theme. And they bought not just the obvious winners like TSMC, Samsung, and SK Hynix, but they bought anything that had anything to do with AI even remotely. So now there's this thing that, with AI needing more servers needing more data centers, the world is going to run out of power. And so companies far down the supply chain, even companies that are involved in power construction, whether it's nuclear power, electric, thermal, hydro, all those stocks had a big rally because retail investors bought anything remotely linked to AI. So we saw junk stocks, loss-making stocks, all kinds of stocks rally because retail investors were buying them. And that is the thing that's been the biggest surprise to me. I also think that, I think there's room for correction here, because while it's true that the AI theme is structural and will require more resources, including power, it's not clear that all of those companies will be able to execute on that demand opportunity. But each of those stocks is being priced like earnings are going to go up 5 times, right? So I think what I've been surprised by is the junk rally in EM. And I think that will be due for a correction at some point. So to recap quickly, the 3 things that have changed since 24 has been foreign investor sentiment around EM, domestic policy support from local governments, and lastly, the retail optimism around AI, which has led to a strong junk rally in emerging markets.
So based on all those, surprising changes that you just shared, is the very term emerging markets becoming obsolete? And should we instead be viewing these nations as individual sovereign powerhouses rather than a monolithic asset class?
There's some of that already happening, Tanya. And you remember when we spoke last time, we touched a little bit on this issue that emerging markets is not really an asset class. It's a bunch of countries put together because there was no other place where they're fit cleanly. And you can see the discrepancy in how major classifiers or benchmark providers think about some of these countries. The long-standing example is Korea, where MSCI thinks of Korea as an emerging market and FTSE thinks about Korea as a developed market. To me, again, it's amazing that a developed market or almost developed market like Korea was up almost 100% last year. I haven't seen a developed market being up 100% in my lifetime of investing. And I've been doing this a long time. But that aside, going back to your point about should we view these nations as individual sovereign powerhouses rather than a monolithic asset class, that trend is already underway, starting with China. And you've seen the emergence of China, the growth of China being almost now back to 35% of the EM index. At some point in time, definitely, I think China will be big enough to be its own asset class. The other reason for this, call it shift, or really thinking of EM as a bunch of different countries, is because the underlying investor behavior is different in these countries. The commonality is that all of these countries have a large retail presence in terms of equity market participation, but retail investors do behave differently in China versus Taiwan versus India. So in our model at Nipun, for example, we view these countries as distinct. The investor behavior is different, the regulation is different, the reporting guidelines are different, the data availability is different. And I think for a lot of asset managers, understanding these differences enables better alpha extraction in EM. So from my perspective, to answer your question, yes, these countries are different. They've always been different. Understanding and recognizing these differences is important from a manager or investor standpoint. At the same time, classifying them as EM makes it easier for an allocator. So, imagine you're a pension fund and you have, let's say, 60% of your portfolio in equities, and then you have, 10% of that in EM. So 60%, 10% of 60% is 6%. And then you want to break that out into 25 individual countries. All of a sudden, you have these tiny allocations to manage. And so I think that's why from an allocator standpoint, it's ease of convenience rather than anything else to keep it as one category. Versus, I think if you think about it from an alpha generation perspective, it's often helpful to break it out. The uber sort of covering around my statement here is the disconnect between how important EM is from a GDP perspective versus how important or not it is in the benchmarks. Meaning that EM is a big driver of GDP growth. Almost 60% of the world's GDP growth is coming from EM. But EM is only 10% of global equity benchmarks, right? So that disconnect is what you see when you think about the allocator perspective versus the manager perspective.
So kind of following up a little bit on that, for the decades, obviously the narrative was emerging markets were risky due to the volatile politics. So, kind of taking how you said, kind of start thinking of these as an individuals, have perceptions of risk shifted in today's global environment?
Yes. Risk is a very slow-moving phenomena. These are embedded in people's minds and mindsets, and it takes a long time for people's perceptions of risk to change. 2 things have happened simultaneously, Tanya. The first is the uncertainty in the US has gone up, because of unpredictable actions from sort of the administration over the last 2 years. Whether that was tariffs, whether it was Venezuela, and I don't know where we're going to go with Greenland, but a lot of that uncertainty has caused investors to have a heightened risk perception of the US. At the same time, many of the major markets in EM are becoming more stable. So if you think about countries like China and India, the reason they're becoming more stable is because their domestic economies have grown to a point where they're less export sensitive than they used to be historically. Domestic consumption has gone up, domestic demand for equities has gone up, and government policy support in these local markets have gone up. The other thing that we've seen in these major markets in EM is that the fiscal balance sheets of these governments have become more stable over time, versus the US debt situation has worsened over time. Again, it's not to say that one is better or one is worse, but just if I look at trends over time, balance sheets have improved in EM at the government level and become weaker in the US. So as a result of this, perceptions have shifted, although slowly, and I think that shift is likely to continue. You could also see a point in time where many of the other EMs, even though they're smaller, like Taiwan, I think, you could see that market also become more stable. I think markets like Latin America are still very high risk because those are narrower markets, smaller markets, fiscal situations still tough. The one area to watch out for in emerging markets is the Middle East, because the Middle East historically has been a very oil-sensitive market. The big change in the Middle East over the last 3 years has been the emergence of Saudi Arabia as a very large market with a very keen political and economic ambition to grow non-oil GDP. So if you think about where China was 20 years ago, one of the things that enabled China to grow was a very strong vision from the leadership, where the Chinese authorities wanted China to be an economic and financial superpower. Now, markets like India and Saudi also have very clear visions of where they want to be. So, for example, India wants to be the third largest country in the world after US and China. And that's a stated vision. And so policy support for that vision is improving year on year. The same thing in Saudi, where Saudi wants a significant part of their GDP to come from non-oil revenues. And so we're seeing investments in infrastructure. We're seeing changes in the real estate sector. We're seeing changes in banking to support that vision. And that's why I have this belief that I think the risk in emerging markets is going to go down over time, where, I wouldn't say that we'll see convergence, but I think uncertainty in the US has gone up at a time when risk in EM is going down. So you're right. And actually it was a very interesting question, because I do think perceptions of risk have started shifting. And over time, Tanya, we're also going to be seeing this in the numbers. Many of us that tend to invest in stocks, we're all very quantitatively inclined, and I myself come from a quant background. We're starting to see this already, that the volatility of Indian equities has gone down over time. We're starting to see that in China. And I think over time, we'll see that in more and more EM countries. So you're right that while EM remains more risky, more volatile than developed, we're starting to see that shift, where EM is becoming more stable and developed markets becoming more volatile.
Wow, thank you so much, Pooja, for all that insight. It's amazing to know what's really changed, like you said, the last 18 months. So I am looking forward to maybe connect with you in the next 18 months and see where we are and maybe get some more updates.
That sounds great. Thanks for having me, Tanya.
Thank you to this month's guest, Pooja Malik, for joining us today to discuss the emerging markets landscape. Join us next time for another Financial Perspectives episode, airing on the last Tuesday of the month. This podcast is produced by CFA Society San Francisco, a not-for-profit professional association providing professional learning and career resources to over 13,000 investment industry professionals worldwide. To learn more about CFA Society San Francisco, visit our website at cfa-sf.org or connect with us on LinkedIn.